hello, everyone, and welcome to this week's edition of the Fat Pitch Podcast. I'm your co-host, Paul Borowski, Chief Distribution Officer of Sealy Investment Securities, and I'm joined by the other host, Clint Sorensen, founder of Wealth Shield, CIO of you name it. Clint's got too many businesses to count, and luckily, Clint, they all seem to be thriving in this uncertain market. This week, we're joined by Clark Briner. Clark, say hello to our listeners.
How y'all doing?
And it's a thrill to have another Dallas guy here with us. For those of you who are new to the Fat Pitch Podcast, it's really a combination of things we thought about, from Ted Williams to Warren Buffett. Clint, why don't you explain what we mean?
Yeah, so Ted Williams said you want to wait on the fat pitch, right? That was kind of the secret to success. And if you ask Warren Buffett, he says it's very similar in investing. The good thing about investing, though, is you don't just get 3 strikes. You can't strike out. So as he would say, is wait on the fat pitch and then take your swing. And so that's what this podcast is all about. It's about interviewing subject matter experts to tell us where they think the fat pitches are now and into the future. And obviously, there's no crystal ball, so we just want to bring you as much information, as much thought leadership as
Clark,
we can.
I like to say we have weekly conversations with legends, luminaries, leaders, and sometimes lunatics from all across the investment spectrum, everything from cannabis to cold storage. But today, Clark, you're a credit guy, so why don't you tell everyone how you got started in investing and what led you to the world of, credit? And some folks may not even know what I mean by credit.
Yeah, great question. I would say I love the analogy of fat pitch, because that's what we're supposed to do in the credit space. Not strike out and hit 99% of the time. What got me into it? My background, unique background. I have both investment banking background as well as worked at a real estate private equity firm. And really, it's just a philosophical thing for me. I am one that likes to do not lose, and I'd rather take a single and double consistently than keep swinging for the fences and strike out.
He's Ichiro, Clint.
Yeah, he's not Babe Ruth, right?
He's Ichiro.
He's not the strikeout king and not the home run king either.
That's right.
So what got you started? I mean, everybody's got an origin story. What got you started in the investment world?
Absolutely. No, I started buying real estate, actually. So I spent the first several years of my career, both at a private equity firm, buying real estate, as well as doing it on my own personal book. And as I started seeing markets, it's just philosophical. I'm one that likes to protect significant downside protection, and I'll take that low double-digit yield in a senior secured first position over a potential 20% return that you get 50% of the time. Year over year, over the last 17 years, I think the data's proven out that we've been right. But in certain markets, the equity guys definitely do well.
So you came out of a real estate private equity shop. How did that work? Where'd you go from there? What's the chronological timeline for Clark Briner?
Yeah, so I went to business school, came out, went into the private equity world. And then I did a little bit backwards. Most people go from the sell side to the buy side. I went from the buy side to the sell side. I went from the private equity firm to investment banking. So I did that bulge bracket Wall Street thing. Great experience. Met a lot of great, sharp people. 2 things I learned there is I probably don't want to be in a 70,000 person organization again. And then
we understand that.
Number 2, my wiring and what I see the world as, I'm probably better on the buy side and running a more entrepreneurial debt shop than working at an investment bank. But no regrets, great experience, great people, and you are sitting at the center of the financial universe when you're doing the investment banking up in New York.
Yeah, I bet the access and just people connections and the network, it's just amazing when you really think about it, especially during that time that you were there, because you were in
What years were you there?
Yeah, you were there during right before the financial crisis, correct?
Pre-GFC and right into it. And then you look back also, the people that were at Deutsche Bank, which at the time was the number 2 real estate investment banking in the rankings, the people that came out of there, the shops they've started, the things they've done is pretty stunning. So the network, the experience, the sophistication, and really just being in the crossfire as GFC was coming into play. As you know, read the Big Short Deutsche Bank was right in the crosshairs there.
Right
we just talked. It seems like Michael Lewis is gets a reference on every podcast. And I said earlier, he's off somewhere writing the crypto story, right? He's got to be with SBF as the centerpiece.
What was your number one lesson, Clark, from the GFC being at that? Because I feel like that probably, and just hearing your background and what you said earlier about wanting to really minimize the downside, right? You want to maximize your protection of that risk, and you're comfortable hitting the doubles, right? You want to make sure that your win ratio is a lot higher than your loss ratio, and you're winning at a nice clip. So what was your number one lesson? Was that kind of philosophy formed during that period, or was that the majority of the forming of that philosophy was probably
correct.
during that period?
It was cemented, I would say, from 99 to 07 was the formative years of my kind of philosophical belief of investing. The number one thing that you look at is eliminating binary risks. And so you need to eliminate binary risks. And how you do that, one of the main things we really focus on here at Revere is going to be alignment of interests. And that's everything from your GP to LP to your employees to, especially on the borrower side, and how you structure debentures, debt, or loans.
That's awesome. Interesting. Yeah.
So walk us through, where do you think the fat pitch is today, Clark? If I had to say, hey, where do you see the greatest opportunity given today's backdrop, right? The macro environment, the micro environment, just what's happening.
Yeah. What's your outlook around that too?
Yeah.
Right now, we're a little bit of the calm before the storm. We have a math problem on the real estate side, is what I keep saying.
That's well said.
When you have 400 basis point increase in the underlying rates at which you're borrowing, we'll just use multifamily. If you look at the math, multifamily cap rates expand, meaning you lose value in the underlying real estate by 50 basis points for about every 100 basis points increase in rate.
So that's a 50 duration for that asset class is what you're saying.
That is correct.
Which is about right, because if you look at equity, I think the S&P carries like a 47 duration. So it's about right. A long-term asset has that type of duration to it. That is fascinating.
And so what that means, right now we're in this stall period. And I hate to say, look back at the great financial crisis, look at 07, look into 08. It didn't hit until a little bit later. What you came into the stall, like you're flying an airplane. You haven't hit the ground yet, but you're not getting lift. And
it really happened in housing in 06. You started to see first cracks in 06. It just wasn't loud enough, right? But that's interesting as you say that.
Yeah, there's just not many transactions happening right now. So where we're seeing opportunity, which is we're more salivating what's going to happen in 3, 6, 9 months from now than what is actually happening right now. I think the debt acquisition business, meaning buying stuff off bank lenders and others that don't have the workout capacity or interest, is going to be a phenomenal business in the latter half of 23, 24, and even into 25.
I heard that opinion posited by another real veteran on the equity side of real estate, talking about the pain. You're really going to see the pain from distressed sellers come Q3 into
Correct.
Q1 of next year.
Yeah, everybody, human nature, not just the real estate individuals. Human nature is you believe that you're strong enough to hold on. The reality is 80% of the people aren't. And the cold, harsh reality is if you sold now, you're going to lose 10 cents on the dollar. You sell Q4, you're going to lose 25 cents on the dollar if you look at that math equation as those fissures and those cracks start to be seen.
Interesting. Side note, it's not really on topic for you, but I've been having some general discussions with folks not in the investment universe. Just sitting out, you and I are in Dallas, Clark. Clint's probably home in Raleigh today, although we could play Where's Waldo. You sit in your office, halfway up Central, and you look downtown and you wonder how many of those floors are empty. At the end of the day, the banks are the ultimate owners of those buildings. When we look at it, a lot of them. How much does that pain in office when these leases start not renewing or less square footage gets renewed as the trends with work from home and hybrid that we all know? How much does that spill over into other sectors? And how do you differentiate the opportunity between the car wreck?
Yeah, office is going to be an interesting space. And I think our analysis and my thought on this is you're going to significantly increase the chasm between the haves and have-nots. You look at the cost to put an employee, all of us have employees. At the end of the day, you have to look, what does it cost to have an office space for Joe or Sally. Well, if Joe or Sally's making $70,000, $60,000 a year, and you're paying $15,000 a year for that office, mathematically, you're going, why don't you work from home a few days a week? Because the cost of, as rents go up and inflation and stuff of that nature. So I think you're going to have a massive problem in C and B office. But I think your A, where you have very high margin businesses, they're going to continue to occupy that Class A and AA office space. But I would not want to be an owner of B and C office. Also, I think CBD is going to have a problem because people have gotten used to, and look, I commute 5 to 7 minutes to work. It's not even that bad. But the guys and gals that I employ that 30 minutes to an hour, I don't blame them when they say, I don't want to drive that hour. I'm going to take Friday and work from home.
For those of you not familiar, Central Business District is CBD. We're not talking about a byproduct of marijuana farms. Just to be clear.
That's not the fat pitch today.
Yeah, that's not our fat pitch today. I agree with you. I think we all know. I mean, we got a kid here who, decided to buy a house on a lake an hour away, and dragging him back in, although he's a wonderful kid, wasn't the easiest thing in the world. So I think you're right. So my question, the second part of that is that spillover, right? Do the banks endure so much pain that there's opportunities for in the private side of lending because that spills over pain from office into all these sectors, and their appetite declines, thereby setting guys like you up like post global financial crisis? Is it the same kind of backdrop?
It's the exact same backdrop. And you look, I'll just give you some metrics in the underlying portfolio just over the last second half of 22. Average yield in our portfolio went up 300 basis points, and the average exposure, meaning risk or loan to value, went down 12%. And so from a risk-adjusted return, in 6 months alone, we are seeing dramatic change. And how's that going to affect the debt business? It's going to help the private lending business because banks, right or wrong, are constrained by the Fed to really look at cash flows. Well, if you have deterioration in the underlying cash flows or rents that aren't being paid or leases that aren't being renewed, your debt service coverage, your debt yield declines. Banks are not going to refinance. And in general, banks do not have the staff and the expertise to work out more complicated situations. So what do? The borrower either goes and recapitalizes the loan with a private lender, or the bank sells it for 60, 70, 85 cents on the dollar, whatever it may be. And the private debt world, or my world, ends up buying that debt. So it gives us a great opportunity to get in the same risk profile in two different ways. I was mentioning to someone earlier today, just to give you an anecdote of where the market's going, we bought our last portfolio of debt in 2014. That's kind of when the good days ran out from the great financial crisis. We made our first portfolio acquisition of debt in July of 22. So there's been, 8 years. And it's not that we weren't looking, it's just we had certain credit metrics and certain return metrics we wanted to hit, and the market was not allowing us to hit those. So we, sent most of the business over to the origination side.
Well, you take that fat pitch analogy, there's nothing wrong with watching balls go by. No. Nothing wrong with taking a free base.
Some of the best
Tell me a little bit, are you seeing
I passed on.
That's right. Exactly. Tell me a little bit about what you're seeing. So that's interesting. You're seeing it pop up on the portfolio side, which is nice, right? Because now you're starting to see some of that pain trickle into the banking sector. And so the percentage of opportunities is going to hopefully continue to grow. But what are you seeing on the private side? I'm hearing defaults. Because I saw a lot of multifamily developments pricing an exit cap in 2 years that are, this year at 4.5, and that's under a 6-month treasury. So I'm thinking, all right, there's no negative risk premium here. A lot of these things just have not repriced. And on those models, they all lose money. Those investors lose money at like 5.5 cap rates. So you start to think a terminal Fed funds rate at 5, you've got to start to see distress in multifamily, especially those developments that we had. And construction spending in multifamily is at an all-time high, or at least in the recent 30-year period.
Fly into Dallas, Clint. We'll tell you about supply of multifamily, but it's all being absorbed so far, Clark.
So fast. I'm curious, are you seeing any defaults? I'm hearing rumors from some of my friends, but are you seeing any defaults in that space? Anything interesting, any distress? Is the first question there.
Yes, we've gotten into a few transactions that Clint, you nailed it on the head, because of the dynamics of both lenders who make construction to perm loans, meaning we'll help you build it and then we'll help you lease it up. They're like, hey, buy us out at 90 cents, 95 cents on the dollar. The construction is done, but we can't hold on for another 12 to 18 months for lease up. And for us, that is a great trade. We don't like construction. We don't think you get paid well enough for that additional risk. But there's going to be, and Paul, you mentioned it, the exit cap rate assumptions when they started that construction 2 years ago were probably in the band of reality when you had 5 basis point 10-year treasury.
Yeah, exactly.
But the world is a whole new place. And when I joke and say we have a math problem, it's impossible, not impossible, to sell something at a 4 cap when prime rate is 7.5.
I'm hearing a lot on the equity side, Clark, about the same thing, and Clint, which is you'll have a good developer, right? People that run good businesses that they may be out there 6, 7, 8, 9 projects, whatever it is, and they got something that they finished 2 years ago, and now they got to sell it at a much lower price, or they got to, somebody's got to go and take that loan at a much different set of economics. So it's definitely a new reality. I think it's interesting too. COVID kind of changed. I don't know what the word is. This whole COVID experience, 20 and 21 into 22. I keep saying to investors, you got to just forget about that period and go back and remember, 2018 and 19 were pretty good years for investors. Things that you got in an abnormal period, that's not reality.
No, it changed everything, to your point, Paul. And I know, Clark, you saw this probably too. Everything repriced so quickly to that just wall of stimulus. Our collective friend, Mark Yusko likes to say that we printed 50% of all the dollars ever in creation in like 2 months.
Yes.
So I don't know what the exact figure was, but it was a lot. And that you saw that in every asset class. And I'm sure you saw, because Paul, I think that's just a great point. I don't think we forget about it. I think we remember that as an anomaly and firmly ingrained that that's not normal. What did you see during that period? Just some examples of the abnormality, and especially on the pricing in like 21 was just nuts in some of these things.
Yeah. Let me get back to that question. Some other opportunity we're starting to see more of is in the multi-space. There was a lot of new players in the mezzanine and pref equity space. And we're seeing a lot of those guys picking up the phone, calling us, looking to help recapitalize, restructure those underlying deals. They are not quite priced where that meet our dynamics. But as I said, until balance sheets run out, people don't actually come to the real trade price. That's coming over the next 6 months. So you're going to see some problems in that multi-space.
That's interesting. And they chased it because of a no yield out there, right? So novices got in.
Guys like me, we can't compete at SOFR 200. I don't get out of bed for SOFR 200, as they say. And, banks, Fannie, Freddie, HUD were very hot to trot on the multifamily space. So we had to pivot into, retail, office, land, industrial, not even industrial, but retail, office, and land during those frothy, printing 50% of the money supply, as you said. And now our book is back up to approximately 40% multifamily, because everybody's retrenched. So we're getting lower loan to value. We're averaging SOFR 650 on the multifamily book, which is 400 basis points above norm just 6 months ago.
You're better than me. I still say LIBOR and catch myself. I haven't made the switch to SOFR in my brain.
Well, Clark, you're literally solving equations, man. This is the cool thing. You said that it's got a math problem, and you're going there and saying, oh, they got the math wrong. And I'm just going to wait until they figure that out. And then I'll come in there and balance the equation out, because you're just bailing out this kind of capital infrastructure that chased hot assets, which I think is fantastic. And you're now moving there because the opportunities present themselves. So that's really interesting. Paul, what do you think, man?
So my question is, you've been doing this a long time. We don't promote track records here. Regulators don't like that. You've obviously done exceptionally well previously and at your own shop, Revere. For folks who don't do well or haven't done well, what do you think the mistakes some people could make now are that you and your shop try to avoid in the credit space?
I'd say in the equity space, I think everybody's learning their lesson about match term debt, match term obligations. For 20 years, we've had decreasing interest rates. And so the idea of caps and swaps and matching your debt for the time you're going to hold it was not really discussed. And now it's top of mind, but you've also seen those caps and swaps bump up to, in 1 year, the cost of them multiplied 20x. And so now it's a little bit more expensive to get into that game. On the debt side, I think the big problem we're going to see for, we don't have this exposure, but most of my peer set does, is the repo problem. And so when you start getting stressed, most every real estate debt manager has a levered portfolio. Almost no one has no leverage on their portfolio. If you have a repo line, you have signed over the ability to your repo provider, which is a large bank, their ability, without check, they're the judge, jury, and executioner, to reprice the underlying collateral just on their belief of impairment. And so what they start doing is saying, hey, we don't like this underlying loan. We're putting it back to you. Come up with cash. That's called the death spiral of debt. And so
the death spiral of debt.
That literally is liquidity preference driven too. It's not fundamental driven. They're not doing underwriting on every single thing. No. They're just saying, hey, I've got liquidity preference. Time to pony up.
That is correct. When you see that spiral starting, it's usually that match term debt problem or the ability for your lender to repo or force upon you a buyback of your collateral just on a whim. So,
and that's happened in every cycle if you think about it. I mean, I'm thinking about savings and loan. You think about a lot of those radio stations and media companies who are getting their loans called, as well as in the real estate market, the GFC. I mean, this is not an irregular occurrence. So that type of event does create a pretty significant opportunity for you, I bet.
It does. And anything that's in the recapitalization space, you don't want to, especially publicly, when other people are seeing challenges, it does breed opportunity for those who may have been a little bit more responsible or more responsibly capitalized through the frothy times. We paid a price, to be honest with you, doing match term debt on our underlying collateral, non-callable match term debt. It may have cost us 25, 50 extra basis points off of our return, but we have no risk in situations what I believe is coming up in 23.
Yeah, when everything is flying, people don't want to hear about risk-adjusted returns, right? It's when people start to notice, hey, that guy's got a pretty good on-base percentage. We had a previous guest talk about 3 risks. He said he learned leverage, liquidity, and concentration. Mm-hmm. So I think about, some of the lessons that you've learned about liquidity. And
leverage. He just gave you the leverage and liquidity because he said that guest said you can't have those two at the same time.
Yeah, I think you think a lot the same way.
Yeah, and concentration is just good portfolio management. We've all learned that lesson as well. When you're blindsided by something, whatever it may be, governmental risk, fraud risk, all those type of things, you don't know it's coming. And when you're hit by it, you want it to be contained to 5% or less of your portfolio.
Did any of you see the article a couple of weeks ago? I get tired of the individual who thinks they're smart in every lecture and asks you about a black swan event. If I hear the term black swan once more. So there was an article talking about snow leopards, talking about how snow leopards attack. They're out there. They're camouflaged to their environment. That's really what's happening, not a black swan. Is if you're experienced, if you know what to look for, and if you've set the right guidelines. I thought that was a better metaphor than a black swan, a snow leopard. So it was an interesting article. Clark, what else can you tell us? Clint started out kind of asking about backdrop, your thesis right now. What's your outlook over, coming out of where we are now? Like, what's your outlook for the next 5 years?
I want to bifurcate that question in the next 2 years. Okay. And I'll go out to 5. Okay. I think we're going to continue to see a slow decline. And I've talked about we're in this paralysis. The bid-ask spread is too wide and the transactions have started to go away. As balance sheets start to run out, meaning the ability to hold, pay debt service or meet debt service coverage and debt yield requirements, you're going to see that death spiral start. That usually is a 2 to 3 year. Like I always joke that my business is the absolute best business, risk adjusted, 3 out of every 10-year cycle. And so you have the opportunity to buy and help recapitalize and solve problems, and you usually get paid phenomenally well for the per unit of risk, which is really what we look for as debt guys. And then there's also what I call green shoot opportunities of your 5-year outlook. Those last 2 years, you need to be on top of what's happening in the market, looking at all the forward-looking metrics, and you need to start converting from, hey, we're no longer workout guys, we're green shoot people. So how do we start getting the guys who may have been knocked down a little bit, and the gals that didn't have the best outing through this, how do we get them back on their feet? How do we get them out there making money again? And, as you're coming out of that, the lenders haven't fully engaged again. Generally the public market lenders are followers, not leaders. They stop lending when GFC is already 2 years in. And that 5-year period is going to be tremendous for a lot of the debt firms out there that are pretty good.
It's a good outlook, Clint. You got a follow up?
Yeah, I was going to say, in terms of other liquidity providers that exist in the space, one of the things that's hurt me in the past is seeing that delayed mechanism, right? Because you have other liquidity providers now that kind of step in, private equity funds, whatever, step in and try to solve the problem too early. And so I think we're seeing some of that now, or we saw some of that in kind of last year, like early people with cash burning a hole in their pocket, a lot of client pressure to deploy capital, right? Return chasing type mentality, pushing people off the spectrum of risk. You started to see some of those holes get plugged early on. And now I feel like to your point, I feel like you could definitely see the music stop here.
Yeah, you're right about the too early. None of us want the Palm Pilot. We all want the iPhone. So
a Palm Pilot.
I'm dating myself, aren't I?
You're the last guy who owns shares of RIM also, right? RIM Technologies. Got your BlackBerry.
The BlackBerry. Yeah.
That's great. Hey, international. You have experience there in the international credit markets. What do you think of things over in Europe right now?
So we focus domestically, or really North America. We do a little bit in Canada, a little bit in the Caribbean. The only thing we do internationally is going to be on the consumer and credit side, consumer and commercial side, not on the real estate side.
We talk a lot about real estate debt. I hang my hat in the real estate equity world. Any other interesting things that are interesting to you right now in specialty credit markets, things like that you find unique and interesting out there that have you up with the pen and paper thinking, how can I make money?
So the consumer, I'll joke about the American consumer, which I know you ask about Europe, but we mainly focus on the U.S. consumer. One thing that you can always count on Americans is in normalized economies, they earn $1 and they spend $1 and we're back to that situation. It's not good holistically for society and the economy, but it's just the way Americans have been wired.
Hey, we learned it from our government.
That's true. Well, I said 102, not 140.
Yeah. Let's stretch that. What debt ceiling?
Yeah.
So that near prime borrower is back to the historic default rates of 2019. So they've digested all that free money, and now they've spent it all that savings cushion that they built. They've gone through that, and they're back to the good old-fashioned $2 for every dollar. We watch that metric quite a bit on that consumer finance side because you want to make sure you're helping consumers, not hurting them, getting them into a worse financial situation. So we're pulling back on the consumer credit a bit. But the prime and near prime individuals are actually the ones that are defaulting at a faster rate than the below prime individuals.
Why is that?
Well, the joke I heard not joke, but a statement I heard that resonated with me a couple conferences ago is below prime, subprime borrower lives in a state of recession every day. So they are used to handling that situation. The people like on this podcast today and our peer set, not used to not having cash flow. And so they just don't handle it as well as the ones that are perpetually in that state. So
that's important. Yeah, good point.
That's a good point. I never thought about it.
So we're pulling back on the consumer side. We're getting a little more aggressive on the commercial side on our non-real estate business.
Interesting. Yeah, I heard another person talking about that's why they like emerging markets, you guys, because small countries and companies are used to bootstrapping it all the time, so they just figure it out. Whereas somebody with a little more largesse says, what do you mean? Well, I'm just not going to pay that. So we have that. Clint, you got some final questions for Clark. And Clark, we'd love for you to tell everybody a little bit about Revere Capital also, when you started it, a little bit more about, I know you're here in Dallas, right down the road from me.
Great. Yeah, we're here in Dallas, based right off Central Expressway. I founded the firm back in 2006. We've been around through a few cycles and a few ups and downs in the world since then. What we do is we buy and originate asset-backed debt. Keep it simple. We look for high margin of safety, high current yields, and our typical investors are looking for a fixed income alternative, absolute return strategy, and that's what we provide to them.
Very cool. Clint, you got another question for Clark before we let him go today? I really appreciate you making time for us too, Clark. I know you've been all over Where's Waldo to start the year here.
Yeah, Clark, I just want to tell you thank you. I appreciate you joining us, being a guest, and love your ideas here. Love the fat pitch you presented. And I'm with you in the camp of, I think we're just in the early stages of this, and any particular credit event or like that sounds like it's going to be, you're ready, you're sitting, you're waiting to take advantage of it. So tell the audience how they can get in touch with you. If you have a LinkedIn, Twitter, anything like that, let the audience know how they can reach out to you.
Absolutely. So our website's reverecapital.com. My email is cbriner@reverecapital.com. Reach out anytime. Love to talk to you about ideas and what you're seeing in the market. And obviously,
that was brave.
That was great. Can we delete that? You can edit.
We're going to edit now. So with that, I want to thank everyone for joining us on this week's edition of the Fat Pitch podcast. We appreciate your listenership, maybe your viewership too, if you like looking at a couple of guys that did not make the male model convention. And if you enjoyed, also share it with your friends. Thanks so much.